Good morning, everybody. How are you this morning? How's everybody enjoying the conference? Good? So this is a presentation that I've updated. I originally gave it in front of the OTC markets last year and given it at a couple of other conferences. And I've updated it for some new information that's come out in the thesis that I have about why gold and silver are going to be different this time. Can you guys hear me okay? Bueller? Good. Okay. So the title of the presentation is Gold and Silver this time is different. This is my thesis that gold and silver is going to be different. It's going to act different this time than it did in 2008, 2000, and even necessarily in the 30s during the Great Depression. Table of contents. I'm going to talk a little bit about myself today. I don't really do this as much in presentations, but we're going to talk a little bit about the history of what we've done at Gold Silver Pros and some of the predictions I've had. I'm going to talk to you about some of the predictions I made over the years, and a lot of people don't do this, but I like to grade myself, so we're going to do that today. Stock valuations, the debt markets, de-dollarization, and central bank digital currencies, and then finally gold and silver. A little bit about myself, what I do and what I specialize in, and I think where people may find value, or where they tell me they find value in my research, is I think basically summed up in this quote by Arthur Schopenhauer. And it's the task is not so much to see what no one else sees, but to think what no one else has thought about that which everyone sees. And I think I take a little bit of a different approach to what we see in the marketplace. A little bit about myself. The first thing I ever wrote was the book. Why I endeavored to write a book and try to publish it, having never published anything before. I probably wouldn't try to do that again. But the book was really cool because it did help me get into different financial outlets, including Seeker Alpha and some of the other ones that you see here. At one point in time, I think we were syndicated across Yahoo Finance, Financial Sense, NASDAQ.com, MarketWatch, and some others. Then I moved into doing social media, so we've grown an audience for economics, finance, precious metals over the last 2 years, and we're on some of these additional platforms other than YouTube and Twitter. I've appeared on numerous alternative media outlets, including Palisades Radio, Liberty and Finance, Arcadia Economics, Live from the Vault, and several others. I've been invited as a speaker or an exhibitor to many conferences, including the US OTC Market, Silver Symposium, Money, Metals, and Mines, New Orleans Investment Conference, Cambridge House, VRIC, Silverfest, Money Metals Summit, which is my conference, and others. So some of the predictions that I want to talk about today to show you some of the value of what we brought over the years. When I wrote the book, probably the longest dated prediction that I made, I wrote in 2009 and published in 2010, was that China was going to prepare an alternative currency to the dollar. And the time that I did this, I then went out into the financial media and said this, and everybody said I was nuts. But 12 years to the date after I said it, China and Russia announced an alternative currency. So I was right, they were wrong, but I understand why people didn't accept it at the time. Nobody could understand that the dollar would not maintain its dominance, and that anybody would not want the dollar to maintain its dominance, and that anybody else would step up and challenge the dollar, except for the history of fiat currencies is that this occurs every single time, pretty much like clockwork on a schedule. And therefore, it wasn't that hard for me to see it and to write it, but I think that the truth about that was not being accepted. I'm just going to hold this up. I think we get a little bit better that way. A second one, prediction that I made was back in 2018 on Seeking Alpha. You've got the date here at the top of this article, where I talked about the global yield curve inversion, how that would lead to both a US and a world recession. And it did. There wasn't a recession in September of 2018, but we started to have that 20% stock market correction. After that, in 2019, you'll see in a moment that I said that that would also lead to a US and a world recession. In another article, most stocks are now a Ponzi scheme, the stock market will crash. I said exactly how this would happen, and it started that crash this year, although I think we're going to have many different stages of that, and when I get into the stock part of the presentation, I'll show you the research on that. On Chris's show, during Silver Squeeze, February 1, 2021, I said, and I was the first one to say this, I think, at least in the community that I'm aware of, that there would be a runoff in the COMEX and London silver stocks. But I said it would take time and it would go through stages. And we're in now what I call phase 2 of silver squeeze, where people have taken so much physical off the markets as it's starting to become apparent. And now a lot of people are documenting how a lot of that silver has come off of the international exchanges. So it's strong retail demand as well as strong industrial demand. And I believe Chen Lin yesterday in his presentation talked about industrial demand. I've heard it's a really good presentation. I personally think that industrial demand right now is draining a lot of worldwide silver inventories, and when the investment demand comes in, you're going to see quite a big spike, although we're not quite there yet. More predictions. I used to have this on my website. I think we're up to 32 and counting that have since been proven true. This is no longer on the website. I'll try to get it back up. I think we may have more. These are just the major ones I documented. Some of them were in the book that I wrote back in 2009. Some of them were in subsequent articles. But I think this is what sets us apart from a lot of people on social media. A lot of people on social media would definitely follow the trends and report on them, but I think people come to Gold Silver Pros because I'm going to be ahead of the curve a little bit more than some others. Prediction that I'm making now that has not come true yet, but I think is probably getting more obvious by the day. The U.S. implements nominal negative interest rates and digital money in the banking system. This is before they formally announced development of the digital dollar, the CBDC. And right now we have real negative interest rates in that inflation is higher than the interest that you get from treasuries or the published interest rate. But I think that eventually the U.S. is going to go to nominal negative interest rates, and they're going to do that in the banking system. There's actually an IMF paper I'll talk about in a moment that documents exactly how they're going to do that. Also a little bit about myself. I am a money raiser and I guess a junior producer for a movie called The Money Game, which has been shot. It is the shooting is completed, and I just got an update from Julian, who is the director for this movie. And the update is that they expect it to be done in December. It should be published in the spring of next year. It is color locked, and they're moving to sound and graphic conform stages. So they're almost done with this. It'll take about 3 months. The movie will be ready, and it'll come out next year. Here's some quotes from that movie. And the cool thing about this movie is, and the difference between this and other movies like The Big Short is, we're avoiding a lot of technical jargon and things that people don't understand. And we're using allegory and we're using illustrations to help people understand how money actually works. Here's a few quotes from the movie. I think the movie's going to be absolutely great. I highlighted the one at the bottom. Correct. And when the Fed intervened in bond markets, they broke the ecosystem of capitalism. I think capitalism is broken. Chris Galizio, who is a friend of mine and a money manager and the executive producer of the movie, thinks it's broken, and that's what we're going to endeavor to show people. That's coming in 2023. I'm very excited for that, to be a big supporter for that project. If you stay tuned to our channel, we'll give you updates as we go along, and then of course we hope that you guys go out to see it as well. All right, on to the stock market valuation part of the presentation. I did say that something was going to be different, and here's what's different from past periods in a nutshell. The Fed has implemented the biggest money printing program of all time, creating 40% of all M1 money supply in 1 year in 2020. The U.S. government has never been in higher debt or had higher yearly deficits. The corporate sector is the most indebted it's ever been and includes $180 billion in negative interest rate yielding debt. A lot of people don't know this point, that the corporate sector has negative interest yielding debt, but they did, and this started last year. The consumer has never been more indebted than at any time in history, suggesting that a consumer-led recovery is not possible in the near future. So that 72% of the economy that's driven by consumers is not going to rescue the economy because they don't have money, and it's not going to come from us. The Fed has no bullets in its gun unless the system changes substantially from what it is now. This is referring to the interest rate posture and the IMF study that you have to have at least 5 to 6 full points of interest rates during a recession to ease and to release the pressure off that. We don't have that anywhere in the central banking system right now. Nobody in the world really has that, at least none of the big central banks. So none of them really have bullets in the gun for this recession that we're currently in. And then the big piece that I'll be talking about quite a bit is central bank digital currencies and the new currency regime. And I'm going to talk to you about what the IMF and BIS have been planning and writing in their working papers and what the next system is going to be, at least if they have their way with it. Something that my friend Chris put together as a wealth manager, and what he talks about a lot in this market is that as a wealth manager, there aren't enough wealth managers left in the world. There are not enough people looking at the system and properly allocating capital. Right now we have the algorithms and we have a very simplified trade. And this is in a nutshell what happens. And this is why stock market and other valuations for assets can go to near infinity. When real interest rates go negative, all assets are worth infinite. That's the way the system is treating assets. That's why you have stock market melt-ups. That's why you have a real estate markup, because you effectively have the debt market's paying you to take on debt and to invest. And so there's really no cost to that debt, and there's no penalty as of yet for taking on that much debt, although I think the penalty is gonna come when that system breaks down. This is something that I started researching last year, and it has to do with price to earnings ratio of the S&P. And this in particular is actually called the CAPE, the cyclically adjusted PE ratio. And I'll explain what that is here in a moment. I want to go through the charts first, and then I'll explain the research on what that is. But as we can see, we have extremely high, 196.67 for July, with a projected 197.06 PE ratio for the S&P. From Standard & Poor's. That's exceedingly high, historically speaking, so the stock market is exceedingly overvalued. This chart on the right really talks about the regression line. So the cool thing about the cyclically adjusted PE ratio is it compares PE ratios to previous periods. So it helps even out differences in periods, period to period. So you could take a 10-year stretch, any 10-year stretch you want, and you can compare it almost equally because it pulls out certain factors. I'm not going to get into the details about how it does that, but it's a really cool little ratio that allows you to look at things over time. So as we can see, we're now the highest above the regression line we've ever been, dating back to 1870. That would be about 150 years. So the stock market from a price to earnings ratio is overvalued all the way back to the beginning of when they started looking at this data. So 2008, 2009 did not clear out the system. 2000 with the tech crash did not clear out the system. And we're actually in a worse situation with the stock market overvaluation than we were prior to the Great Depression. This is from a standard deviation perspective. And what that means is, if anybody remembers back to their math class, the further you get away from the mean line, the more of an extreme you're at. And from a financial perspective, what they noticed was more of a snapback you get to the mean or to some median historical valuation that lines up with history. So as you can see in the 2000 tech crisis, we were at 155%, the highest that's ever been over valuation. From an arithmetic mean, from a geometric mean, 178%. I'm not going to explain the difference there, but if you're interested, go to Advisor Perspectives and just look up CAPE, and you'll get the series article that this author wrote, which is a really great series that she's been updating over the last year to talk about this. The one thing to know about this, when we get into that last standard deviation, usually when it reverts to the mean, it doesn't come down to this mean line at the bottom, it goes below. So you get a historical undervaluation of the stock market. That's always been true since this measurement has been taken, and we have not gotten there. As you can see on the far right of the chart, we have not reverted back to the mean, and we have not reverted to below the mean, even though we just had the most overvalued period of stocks in history using this ratio. So the correction is not over with the stock market. If history is any guide over the last 150 years, we've got a much bigger correction coming. This number, when I first gave this on the OTC markets, this number is actually higher. Right now, we're at 92.6% in terms of the ratios. You can see this compared to other periods. The tech bubble, the 1929 peak, the 2007 peak. With the recent stock market correction this year, that number has come down. And I think I'm going to switch because this is not working very well. Is that better? Yeah, that's much better. Thank you guys, sorry about that. Anything so far that I've talked about, anybody has any questions on since I had mic issues? Okay, good. So the CAPE ratios have begun to fall a little bit, but we haven't cleaned out the system. So it's been a nice little correction that we've had, but we're nowhere where we need to go to get those price to earnings ratios for the corporate sector to align with historical norms. We've got a long way to go. Where did this come from? Well, it came from Benjamin Graham, David Dodd, and Robert Shiller, who popularized the PE10 or the CAPE ratio. The PE10, also known as the cyclically adjusted PE ratio, just shown is the calculation of the PE ratio over a 10-year average to reduce the distortion of temporary swings in the business cycle and to allow for longer-term comparisons. The biggest finding in the study was that when that ratio falls from the highest to the second quintile, it always bottoms to the lowest quintile and typically into the single digits. So I'm going to go back and look at this chart. Highest overvaluation of the stock market ever, when it comes all the way down, it's going to go below that bottom line on the chart. So we've got a long way to run, if history's any guide. I believe that we have one more market melt-up coming. I think that the Fed, due to the debt issues and due to the economic problems, eventually is going to roll out the helicopters. And I think when it rolls out the helicopters, the stock market valuations are going to go way into that fifth quintile. I think it'll be much like what happened to some of the stock markets during the Great Depression, when the valuations in assets rose, but the inflation but the inflation rates are basically going to be higher than the valuations, and so therefore you'll have a net negative return on a lot of your asset classes. I expect that this will occur again when the system finally cleans out. So what's going to happen when all that stuff happens? Gold and silver are going to go up, of course, because they're the contrarian trade. And that's why I started Gold Silver Pros a couple of years ago. I've been writing and researching for years, but I saw this, not necessarily in the format I'm presenting to you, but I saw this in the data, and I said, I've got to focus on gold and silver the next few years and educate people to help them, because I think silver especially, but gold and silver are going to be the biggest asymmetric trade that I will likely ever see in my lifetime. So what about the debt market? This is a study done by Reinhardt and Rogoff in a paper that they wrote years ago. This became very popular when we were going through the last financial crisis. They did research after that, and I think published this in 2010. So this chart goes to 2010, but I'll talk about it in terms of what it means today on the next slide. It's a very busy chart, but the main thing to understand is that this blue line is talking about the percentage of debt that we have to GDP. You can see when they originally did the study, it was back about 80%, the numbers there on the right. All the other bad stuff that happens is encapsulated in these other colored areas. Basically what it means is, once any country gets above 80 to 90% debt to GDP, they start having a lot of defaults, they start having restructuring, and they start having high inflation. So where are we here in the US? Well, according to the Fed, we passed that line of no return back during the last crisis, back during the 2010-2011 timeframe. We were, I think, peaked at almost 140% of debt to GDP during the pandemic, and we're still sitting over 120%. No country in the history of the world has ever survived that condition without having to restructure, without having high inflation, without having to do a lot of, without having basically a crash in its markets, a crash in its asset markets. Negative interest rate debt. The rise of negative interest rate debt, or the promise of a negative return on investment for bondholders, has removed risk management from the financial profession. We now have the moral hazard that everybody's talked about for the last 10 to 12 years that's arisen in the sovereign and corporate debt markets, where issuers get incentivized to take on debt and have no penalties for misallocating capital to non-productive endeavors. So what does that look like? That's what that looks like. The wealth effect. Everything goes towards infinity. People get euphoric. People put more money in. But that doesn't last. Why doesn't it last? Well, let's talk about why that doesn't last. Here's a case study done by the BIS, and it was done, I think, somewhere around 2013, 2014. They were looking, as a result of the last financial crisis, 2008, 2009, they started to look at zombie companies. And a zombie company is basically, in BIS terms, if you read the paper, defined as somebody that can't service their own debt, or can't, without additional debt issuance coming to them, free money coming to them, continue as an ongoing concern. They're a zombie company. And unless, if the Fed were ever to substantially change or pivot higher on their interest rates, then this would become a big issue. But this is across the world. This is not just US companies. But the interesting thing about this chart is, not only do we have a higher percentage on the left of zombie companies, according to the BIS, they have a lower confidence that any of those companies will ever recover, ever across the world. There's a 90% chance that 16% of companies that are zombie companies will never recover, ever. That's what the study said. That's what happens when you have the debt cycle, the negative interest rates, the free money. So here's the crash sequence as outlined by Rogoff and Reinhardt. Where we are in here, I'll leave that up to you to interpret. But essentially, it begins with financial liberalization. So if you look, I think it was Glass-Steagall where they separated or removed separation in the banking system and other easing that we've had in the system, basically dating back to the last financial crisis. This is the process that you go through, that they documented through all the other countries that they studied. So it's interesting, you know, they've got the whole playbook basically in this paper about how this has happened across the world in the past. And I wanted to throw in consumer debt, and this is a really cool chart from debt.org, because it shows the amount of debt that we're all taking on. So basically the pattern is, as you get into your peak spending years, the Gen Xers are really in their peak spending years right now. I'm a Gen Xer, I'm 47. You accumulate the most amount of debt. So most of what people own, their cars, their houses, so on and so forth, they don't own. They borrowed, and they're living on a borrowed lifestyle. Now, where we had an expanding economy, this is not such a big deal because you can simply just deleverage as you get older, stop spending, buy more assets. But in an era in which we have high interest rates, a lot of financial suppression, and lack of jobs, and things like that, this is going to break. And so I think the baby boomers, the Gen Xers, and the millennials are in pretty serious trouble in terms of their personal debt. I don't see how you deleverage the entire consumer sector without crashing the economy or without doing like a debt jubilee. I don't believe that the government and the banks want to do a debt jubilee. So I suspect that a lot of this debt is going to default at some point in time. The debt must be addressed. That's clear. A debt devaluation must occur for the system to recover to normal levels and to begin to heal for the next upward cycle. But this time is different because we're at the end of a super cycle. And that's what I'm going to talk about today, or talk about on this slide. Sir John Glubb was a gentleman that was in the military for the Crown, also led several militaries in the Middle East for the Crown's interests, traveled around the world, saw a lot of stuff, and then became a lecturer. Did a really good study in the 1970s. I call it the rise and fall of nations. He called it something else. But he talked about the life cycle of a nation. And the life cycle of a nation basically goes like this. You have an event at which the nation state announces itself to the world. In this case, with the United States, it was a declaration of independence and the eventual separation from England and the Crown. And then over about 250 years, certain stages take place. And at the end of that 250 years, that nation state no longer is the dominant nation state, another nation state rises. And he went back 3,000 years, almost 3,000 years to the ancient Assyrians. And from all the data he could collect from most of the major civilizations, including Rome, including the Spanish and others, and basically figured out that this pattern repeats over and over and over and over again. And at the time he wrote it, he was talking about in the paper how this applied to England and how it was the rise of America and the eventual fall of some of these other traditional European powers. And it was very, very interesting. The other piece of research that I like to talk about when we're talking about wave theory and we're talking about repetitions in markets over time is Kondratiev. Kondratiev was a Russian political economist who the Crown at the time, and this was some 100 or so years ago, I think he did this research, the royalty at the time in Russia said, hey, do some research and tell us why economic cycles happen. Why do we have these economic cycles? We want to try to smooth these out. Why did the Crown care about that? Well, they cared about it because they would get revolts from people when they couldn't eat and when they didn't have goods and services. And so what the Crown was really trying to do is try to figure out how to get people from stop storming, the palace. And so he basically illustrated, well, it's your fault because it's your monetary policies that cause it. And then they jailed him. And then after that, it got picked up by some other economists across the world, and they started writing about it. So that's an 80-year cycle. A lot of people that follow seasons or the fourth turning is based upon Kondratiev's research. And essentially, it's 4 generations, 20 years each, give or take. You have a spring, a summer, a fall, and a winter. And then you have a rebirth into spring again. And this occurs in financial cycles pretty much throughout history and every major civilization without fail that researchers have looked at it. So it's very, 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 very powerful research, along with what Sir John Glubb did. Well, it doesn't take long to figure out that once you have 3 of these economic cycles, that's the end of your nation state. So what happens in each economic cycle is the reaction to that cycle is for the government and the banking system to provide more liquidity, to ease, for that country as well along the way to give up its manufacturing and all these other things. Everything that we've seen happening in the United States has happened to all of these other civilizations throughout history over the same time period, over and over and over and over again. So that's now why the World Economic Forum and other people are talking about the Great Reset, because we're at the end of the nation-state cycle for the United States. It doesn't mean we're going to disappear. England didn't disappear. Rome may have fallen politically, but I still believe that they're still there. I mean, they didn't disappear. They didn't fall off the face of the earth. It's just that you go through a reimagining of the financial system at the supercycle peak, which we're at in the Western system. So the Western system depends upon a redesign this time, not just a reset. Why? Because we're at the end of the current fiat monetary cycle, and therefore the monetary system itself must change. Leading into de-dollarization and central bank digital currencies. Why are we having de-dollarization challenging of the US dollar as world reserve currency and central banks developing digital currencies? I'm going to talk about that. So IMF did a big research paper in 2015. I caught it in 2018 and started writing about it to my private subscriber list in 2018. I no longer have a private subscriber list. Once I saw this, I killed that private subscriber list. I started going to social media and I started telling the public. Because at this point, I wasn't going to I didn't want to write this for just a few hundred people. I wanted to write this for everybody to see. And this is actually what caused me to no longer do subscriptions and to just put out all my content for free. So the IMF, in this paper, proposed getting rid of cash and moving to all electronic money. The paper hypothesized the end of the current debt-based fiat system and proposed electronic cash where aggregate monetary flows could be centrally managed by government through the central bank to control inflation and deflation cycles. And originally this idea about this concept and negative interest rates didn't come about in the last 20 years. It was actually written about by an Italian economist called Silvio Giuselli in, I believe, either the 1870s or 1880s. So the concept of negative interest rates and centrally managed monetary aggregate flows is 150 years old. This research was picked up by Irving Fisher and John Maynard Keynes, who's the author of Keynesian economics. So they knew eventually, I believe, that we would eventually have to go to a negative interest rate system. They knew that. Why did they know that? If you look at the history of the bond market, and this is something I put out on the channel maybe a year ago, 700-year history of the bond, of what I call more accommodative conditions for bonds, interest rates falling. 700 years. Now, certainly, that's not in the United States. We haven't had, U.S. Treasuries for 700 years. It's a worldwide phenomenon that basically over the last 700 years, the entire world has been in a quantitative easing cycle. And I believe that that is finally reversed. So some of the trends that I look at are not just 10-year trends, 20-year trends. I look at 700, 3,000-year trends when I'm making my predictions. And I think that's why I have so many successful predictions, because I tend to look a little bit farther out than a lot of people do. So negative interest rates in this paper would be used in the banking system. So we're not talking about bonds. We're talking about you get $100 for your paycheck. It goes in the bank, and they give you 95. And that 5% discount is negative interest rates. Why would they do that? Well, in the paper, they realized that people would not accept this unless they used the existing system. And they said, everybody has a bank account. People get direct deposits. We can control this automatically. So when you get your check deposited into the system, they said in the paper, the nanosecond it goes in there before you have any access to your own money, they're going to discount the value of your money by whatever interest rate that they set, negative interest rate that they set, and you've got no say in it. And in the paper, they said there's no lower bound to this. If we need to go negative 40%, we'll go negative 40. If we need to go negative 80, we'll go negative 80. They're serious about this. They want to control aggregate money flows. The bond system does not help them. They want to get rid of bonds, and they want to go to this system. The other way in which they can control aggregate money flows in the system is through taxes. So that's why the IRS, I believe, just hired 90,000 new associates, because they're preparing for that. They're preparing to control the system through negative interest rates in the banks, and they're also preparing to control it through the IRS and enforcement. And again, it's not conspiracy theory. The paper's right there. There are subsequent working papers I published as well. You can go read it for yourself. In CNBC, I saw a news story probably about a year ago that said that the BIS and 50 central banks are all signed up for this. So if you think that this is not coming to a central bank near you, It's already been announced in the public. And so therefore plans are underway to develop the technology to implement it, which will incur in various stages. I won't go too much into those stages right now, but they're developing the rail system for the central bank digital currencies to connect together. You've got development of alternatives to SWIFT. By the way, the Chinese system depends upon SWIFT, and a lot of people don't know this. China is developing its own wire system, but it depends upon SWIFT. It's interesting that China hasn't separated from the SWIFT system, that they're dependent upon the SWIFT system. And I think that essentially the Chinese central bank, along with the other central banks of the world, are going to use the same system. So I think a lot of what people have been talking about in the development of alternative payment systems, it's not necessarily China against the US. I think it's China with the US. But I think they're ring fencing their own individual sovereign markets, currency markets. But I think they're going to work together because they said that they are. So this is from the Atlantic Council. The Atlantic Council is one of these sort of think tank, elite research institutions that's tracking the central bank digital currency projects across the world. There are a total of 112 being tracked at the moment. 11 have been launched, 14 are in pilot, 26 in development, 47 in research, including the United States' digital dollar. 10 have been made inactive and 2 canceled. Coming soon to a banking system near you. So out go the fiat currencies, in come the central bank digital currencies. And of course we have de-dollarization is amping up. China deal with Saudi Arabia to deal oil for yuan. Russia requiring its natural gas to be paid for in rubles. And I read a headline this morning that Russia has officially shut down Nord Stream 1 to Europe. They said they do it for a few days for maintenance. Europe is worried that it's going to go into the beginning of September. But no longer is natural gas flowing from Russia to Europe at the moment. China, on the other hand, is taking some of that natural gas. It's buying it from Russia because Russia has a problem with its ports and its distribution system. It can't get all of its gas out. So China's taking a lot of it and they're running it around and selling it to Europe. So Europe is getting some natural gas, but it's going through China at the moment. Russia also decided to manage the ruble by setting a gold to ruble exchange rate. A lot of people thought that that meant that they were setting the ruble to gold, but they weren't. A really brilliant analyst, not super well known, but goes by the name Dezo, his real name is Kieran von Hess, came on my program and illustrated how this exchange rate was actually to cap the value of the ruble, because what happened when Russia required foreign countries to buy its natural gas in its ruble is the Russian ruble went like this. And so they had to cap it to gold, and that's actually what that was. The gold to ruble exchange rate is a cap on the ruble. They don't want it getting too strong. And of course, China and Russia are working on competing currencies and payment regimes. That's been in the Financial Times and all over the press, if you guys haven't seen it. And they've announced that they're working on an alternative to the dollar as a global reserve currency. So what does that mean for gold and silver? I think there are big changes in the system, and I'll go through what I think those are. And then I only have a few minutes left, so I'll try to take questions. Gold is used as a central bank barometer in the new system due to Basel III rules, making price-hedged physical equal to cash as a high-quality liquid asset in the banking system. What does that mean? It means that all the central banks are going to recapitalize their balance sheets with gold. Gold is going to be at the center of the new system. It's going to be one of the assets at the center of the new system, along with the central bank digital currencies and along with ownership in the other central banks, shares of other central banks. Gold is being held in strong hands at the moment. It's being discouraged for individual use. That's through the taxing regime, which Independence Money will be covering this weekend, and through other ways as well. Individuals will be expected to support the new central bank digital currency. And SDRs will be the top level of the system for trading amongst the central banks and sovereigns. And there's something I wanted to clear up about SDRs. There's a great research paper that I read in Zero Hedge the other day that talked about this. A lot of people were worried that 600 billion or something, 60 billion new SDRs were allocated from the IMF. But that doesn't create any sort of inflation because the SDR is not a currency. It's an exchange mechanism. What an SDR is if China wants US dollars, they can sell SDRs and they can get dollars. And that is a peer-to-peer trade facilitated by the IMF. So SDR is just a way for sovereigns outside of the traditional FX markets to gain liquidity in another currency that they need through the IMF. So the SDR is still going to stay in place, but it's not going to be a global currency. It's just going to be a trading mechanism right now between the fiat currencies, later on between the digital currencies. So it's all going to be automated, and it's all going to be put on the computer system. Silver is different. I think silver has been commoditized in support of industry, such as green programs, medicine, space, military, et cetera. It will, so right now, the situation with silver, and the reason I think that it's not allowed to trade freely, and we know that because of what Rostin Benham said as CFTC commissioner, we've documented that. We know that they put an upward circuit breaker on the price of silver. They admitted that in public. I think the reason they're doing it is because silver is so critical to many, many things, to EVs, to solar, to energy, to war, to the war machine, to militaries, to space, to medicine, to everything, and there's such a lack of it right now. We're running current deficit 4 years in a row, according to the Silver Institute, and supplies are starting to come off the exchanges. We're really starting to dwindle on our above-ground silver inventories. Not out yet, but we're getting there. That I think that they can't allow silver to run too high, and I think that what they're trying to do is make sure that industry has enough at a cheap enough price point, and they're controlling the distribution of silver through the exchanges to try to funnel it to the right people. I do think, however, that investment demand is going to get very strong during the next crash. We always have crashes, so whether it's a recession or a depression, we know it's going to come. And I think when that happens, silver will be monetized by individuals looking for value as the supply crisis becomes more apparent. The financial system will see it as a commodity. People will see it as money, and you're going to see a divergence in price. You're going to see the exchange price, which is what is spot now, or relatively close to spot. And then you're going to see the free market price. And I think that we're going to see a big difference. Right now, that's characterized by really high premiums when you go to your dealer. But I think that people are building alternative measures to publish a free market price. In fact, I know that's occurring. I just can't talk too much about it. And I think there's actually going to be more than one price quote. And I've said many times on my program, I also believe through all of these new gold exchanges are popping up around the world. France has opened a new gold exchange. India's opened a new gold exchange. JP Morgan is assisting Shanghai and China with expanding, their availability to commodities markets, gold and silver. I think that is going to cause a lot of regional pricing in the precious metals as well, especially silver. I want to cover gold-silver ratio here for a moment. Here's the pattern we've had for the last few years. Gold is a barometer of the financial system. It rose for a while. You had COVID, at which it reached pretty much an all-time high to silver. Silver caught up eventually. This is what happens. Silver catches up eventually. People will go into silver after gold pops. And so you saw that ratio come down. And then since about mid-2020, well, actually about the beginning of 2021, you've seen a gradual rise in gold again. And I think eventually that pattern will repeat. But I think this time, silver gets really high in the gold ratio compared to gold. And that's something I wrote about in 2011. It's one of the first articles I wrote about that I think the gold-silver ratio would widen, but I think ultimately it would shrink. And if the mean is 15 to 1 or 30 to 1 or whatever number anybody wants to use, I think it's going to go past that. I don't think it'll stay there, but I think it'll go past that for a period of time. All right, so that's it for my presentation. Any questions? Oh, 3 favorite crypto coins. I mine Bitcoin just because it's the predominant one. I would say from the other ones that I like are Hashgraph, which is, it's not a crypto coin in the concept of like Ethereum, like a proof of work, proof of stake system, or Bitcoin. But I like that one because the guy that developed it, I think, put a lot of thought into it. The one concern I have with Hashgraph is it's administered by a council of corporates. And so corporates will then control the issuance of that money. And I don't really want corporate money. I want free market money. So I kind of like it, but I don't like the fact that it has a corporate board of directors over it. Other than that, I may say Monero just because it has certain privacy features. But I don't invest in the other ones. The only one I invested in was Bitcoin, just because it's the predominant one and it's just a speculation. Right now, I don't see Bitcoin as being a currency. It's a speculation. So I'm not treating it as a currency. I'm not holding it as a currency. That's why I don't go buy it retail. I just bought a miner. I'm going to produce some. I'm going to sell it, and it's just a trade, basically. Thank you. So the question essentially, is it around the dollar and post-transition of the dollar? Is that what you're asking? Okay. So the dollar is, I guess, the best horse in the glue factory. If you look at the dollar milkshake theory, the dollar milkshake theory put out by Brent Johnson is coming true right now because the dollar's overvalued according to, per everything else. And that makes sense. It's a world reserve currency. But I think with de-dollarization and the new currency regime, that's not going to matter. And eventually all the fiat currencies are going to go away. But they've been working on the digital dollar for a while. The Fed has a FedNow system, which they can put money into and out of your bank account. So again, they're going through the banking system, but the actual mechanism of the digital currency is under development right now. There are a lot of projects going on that are trying to help the government develop this. And essentially what it was, the private digital currencies had to come out first, because the private sector is always going to develop faster than the government. The government's going to look at what they're developing. They're going to take it, modify it, and say, how do we control this? They're going to flip it from decentralized to centralized, and they're going to implement the existing system. If you tried to just run a pure digital currency system and get rid of all of our existing financial systems and accounts, it wouldn't work. People wouldn't accept it. But if you can run it through the banking system, and then you have a currency crisis, which is coming, and you say, oh, wow, everybody's going to CBDCs, and everybody's been conditioned by the cryptos to accept digital money, it's not going to be that hard to implement that, I don't think. And that's why you see on the Atlantic Council chart, this elite think tank, hint, hint, elite think tank. This is the design. It's not only a tracking chart, it's by design. The whole world is doing this. Whether you like it or not, it's coming. Thank you for the question. Okay, so the question is, thank you very much. So the question is about the dollar and gold rising simultaneously per the dollar milkshake. I've always said the dollar milkshake theory works until it doesn't. When it doesn't matter because you don't have the fiat currency anymore. So I think it's correct. It is correct. But that theory is not going to exist forever because you're not going to have the paper dollar anymore. I stay in touch with it because I do have connections in tech and stuff like that. When you see more of these projects on this map up here go into basically the green, then you're closer to having it happen. The infrastructure is not quite there. They're still building the rail system to connect these digital currencies. XRP is a candidate. JP Morgan's working on an alternative as well. So the infrastructure is being laid in place. They're also working on the wire systems. They're trying to get China and Russia aligned with the US Western wire system. People think that China and Russia are developing their own. They kind of are, but they also want a connection to the US. So I think there's going to be two pieces to that. I think the BRICS nations are going to have their own internal payments transfer system, but they also want to interface with the Western world, and that's why they're integrating with the SWIFT system. So the Chinese system does integrate with SWIFT and does depend upon SWIFT. And so I think that they're going to have both. The question was, are all of these other countries using precious metals in trade? And sort of like a black market or alternative market, was that your question? And you gave a list of companies. I'll just say not UK, not Europe, not United States. So third world countries, essentially? Okay. So yeah, so are third world countries using precious metals? I'll give you an anecdotal example from the past. My ex-wife is from Cambodia, the Khmer Rouge, Viet Cong, that whole Vietnam War. Her parents were teachers, and teachers were murdered and suppressed and put in concentration camps. They got put in concentration camps. The way that they got out of that concentration camp was gold. It was in form of jewelry. And my mother-in-law said, if we didn't have the jewelry, we'd be dead, and you never would have met us. We never would have come to the United States. So I think in periods of stress, yes, precious metals will be used. Have I heard of precious metals being used? I don't know because it's anecdotal reports. I don't think you're going to see it in mainstream media, but I use them. I barter precious metals all the time. So I would say yes, from my perspective, they do because I do it, and I'm sure people do. But in history, when you have those sorts of difficult times, the more difficult they are, the more people use precious metals to trade. Also, an interview I did with Fernando Aguirre, who went through the Argentinian currency crisis in 2000. I've interviewed him a couple of times on our channel and at our conferences. He talked about how the Argentinian currency wasn't worth anything and they had the dollar, but there was a lack of dollars, so people started bartering goods and trading gold and silver, anything that you could have. And they would barter a chicken for, a bike or whatever the case may be. So yeah, definitely during times of currency stress, people go to alternative systems and not necessarily the predominant system. Okay, so I'll sum up real quick for people because I know where you're going with this. Thank you for the question. It's a really good one. So he was talking about, will they confiscate precious metals? Well, I think it was 1933 when they had the act, that was the executive order where they took the gold, which by the way is unconstitutional, where they took the gold, remelted it. They took it and remelted it and funded the Exchange Stabilization Fund, which is the fund that intervenes in every market. So if anybody's wondering if any market's intervened in, we have a formal agency funded by the gold confiscation in the 30s and subsequent activities, financial activities, that actively intervenes in every market. Will they confiscate gold again? I don't think so, because not many people own it. I think they're just going to tax the hell out of it. And I think that's why the presentation by Independence Money that you guys are going to see is critically important. I don't think they have to confiscate, and I don't think they have an enforcement to go door to door, because really who owns gold and silver in this country is just a few people. It's the people at this conference. It's not everybody else out there, right? We're in the minority. They don't need to confiscate it. They're going to tax it. And so the strategies they're going to talk about is going to become extremely key, I think, going forward, if you're a precious metals holder. Not only precious metals, but other things like real estate. Yes, sir, right here.
What's our timeline on this? How long till the
No one knows. Because it's the first time it's ever been done. But I suspect, looking at the stress in the financial system, it's going to all come down within the next 2 to 3 to 4 years. I've kind of predicted maybe somewhere in the middle of this decade, but there's how people react to that. So I would say that's largely dependent upon you, to be honest. If you look at when the Chinese did their initial rollout of the digital yuan, their citizens 100% rejected it, which was a surprise to the government because their citizens favor Bitcoin and favor all of these things. So what China had to do was outlaw Bitcoin. And it's now illegal to own or trade Bitcoin in China so that they could get their central bank digital currency system into place. And what they're doing now is I say propagandizing, they say educating their public about the benefits of central bank digital currency, and they're starting to get more acceptance. So it's a process. And in the IMF paper, they talked about it takes about a generation or a generation and a half for people to accept these types of changes. And that's why they're pushing it now, because they know it's going to take 20 or so years. So it's not like they're going to flip a switch. It's going to happen gradually, but it's going to happen. And they know it generally takes about 20 years. On the chart that the IMF published about which countries around the world use more currencies, more cash, you have some countries in Europe, like the Swiss, like the Germans, United States, Mexico. Some of these countries have higher cash rate usages. So they actually had a chart that said, it'll take us this long to get the people in the US on this system. It'll take this long to get people, in other areas. So they know, they have their whole plan there about how long it's going to take. But the exact dates we don't know, because a lot of it depends on how you guys accept it. If you don't accept it, it'll take longer. If you do accept it, then they can roll it out as fast as they want to. So the question is, why will gold and silver go up during a crash scenario? Because historically they always have, because people go to a flight to safety. What has absorbed that in the past has been bonds and dollars, but if you don't have a bond and a dollar, how are you going to go flight to safety to a bond or a dollar? And further, they're going to recapitalize gold in the system, which means they need to revalue it. So a lot of what Lynette Zhang has talked about, sorry about this, I'm trying to get rid of this mic. A lot of what Lynette Zhang has talked about has been how they use gold to revalue the new currency. So when we go to central bank digital currencies, depending on how much gold you have, it's going to be a competitive thing between the big nations. Oh, our currency's stronger. We have better high-quality liquid assets. What are the HQLAs? Right now, as defined by the BIS, it's stocks and other banks, cash of the realm, so to be a digital cash, the strength of that, how much, and your gold reserves. And they're going to revalue gold. Silver's different. I think they're going to try to keep it low because of industrial demand, but I think the market's going to overwhelm them. I think the market wins the silver eventually. But I think that the industrial demand has weakened above ground silver stocks and set up the big squeeze, but I think the squeeze comes when people come into silver for monetary reasons. And I think that breaks the system. And I think that's where the COMEX goes away and those types of mechanisms. So the question is, will the dollar collapse? Yes. All fiat currencies collapse over time, 100% rate. Yeah. Oh, I got you. I'm sorry. See, I did mention the market melt up. So I think we're going to have a Minsky moment, or we're going to have the Austrian economist version of a melt up. And the melt up is going to be similar to what happened in Germany, where they're printing so much currency and people lose faith in it, that you have such high inflation rates that it bids up the asset markets. But because you have a destroying currency, you lose more on the value of the currency than you gain in the asset markets. That's why you want to be in gold and silver, because that's going to hold your value, whereas the currency won't. Now, I've never advocated anybody ever getting out of the dollar. I'm sitting on a pile of cash, because the dollar is king until it's not. And so I have buckets. I have cash, I have gold, silver, I have other things, businesses and things like that. And that's just how I've structured myself. How you guys do it's up to you, but that's just kind of the way I decide to approach it. Yeah, I think we're out of time, so don't ask it here. See me after, and I think I'm over my time. Thank you guys so much for the presentation. Appreciate you. Booth 25 over here if you want to come see us.